Here's the complete YouTube video script in English, written in the first person as Kevin O'Leary. It flows naturally as one continuous, engaging conversation, perfect for a 20 to 30-minute video aimed at viewers aged 28 to 65. Hey everyone, it's Kevin O'Leary here, Mr. Wonderful from Shark Tank, the guy who built his wealth from zero to hundreds of millions by avoiding the stupid mistakes most people make. Today, I'm talking straight to you, people between 28 and 65 who are working hard to protect and grow your money in this uncertain economy. If you're thinking about buying any of the 5 overpriced assets I'm about to list in 2026, listen up. You could be setting yourself up to lose a lot of money. I've seen this play out hundreds of times on Shark Tank. Smart entrepreneurs with decent money pour everything into things that look safe, things that feel like symbols of success. Brand new luxury cars, high-end watches, designer clothes, lavish vacations, or even overhyped tech stocks. They think those things make them look rich, make them feel rich. But here's the truth. Those things are quietly draining their wealth. And in 2026, with inflation still lingering, interest rates fluctuating, and recession risks looming, continuing to spend on them could turn out to be one of the biggest financial mistakes ordinary people make. The problem is, these luxury assets feel safe. They make you feel like you're living the rich life, driving a luxury car, wearing a Rolex, dressing in designer labels, flying business class. But that emotional safety is exactly what makes them dangerous. In today's uncertain economy, where certain stock sectors are overvalued and luxury demand from the middle class is slowing down, pouring money into these items isn't investing, it's disguised overspending. I'm warning you about this because I've watched too many people lose everything simply because they couldn't control their luxury spending. In 2026, if you keep buying these things, you could watch your wealth get eroded fast, not from a sudden market crash, but because they deliver zero real value while your money could be building lasting wealth elsewhere. Most people are ignoring warnings like this, telling themselves, I deserve it, or just this once. But let me tell you from the experience of someone who got rich by cutting out the useless stuff. If you don't stop now, you'll fall behind the truly wealthy. People like me who prioritize protecting capital and letting money work for them. Picture this. You're in your 40s or 50s. You've got a decent nest egg saved up, but instead of letting it grow through smart investing, you drop tens of thousands on a new car that loses 20% of its value the moment you drive it off the lot. Or an investment watch that's really just expensive jewelry that doesn't appreciate in a crisis. That's not how rich people think. Rich people buy assets that generate income, not things that just make them look rich. In this video, I'm going to lay out the 5 overpriced assets you should stop buying immediately in 2026. I'll explain why they're more overpriced than ever, based on what's actually happening in the real economy, from the luxury market slowing in China to overvalued tech valuations and shifting consumer demand. And most importantly, I'll show you what to do instead, how to think and act like the truly wealthy so you protect your money and build sustainable wealth. If you're watching this, chances are you're worried about losing money, afraid of falling behind in tough times, or scared that some of these bubbles might pop. I get it, I've been there. But today, I'm going to help you see things clearly. Stick with me, because what I'm about to share could save you from expensive mistakes. Now, let's dive into why I'm telling you to stop buying these 5 overpriced assets in 2026. I'm not just talking out of thin air. This is based on real economic data I follow closely from reports by Bain Company and JP Morgan, plus the hard lessons from hundreds of Shark Tank deals. The personal luxury goods market, things like luxury cars, high-end watches, designer fashion, lavish trips, and premium handbags, slowed significantly in 2025, and forecasts for 2026 show only modest 3 to 5% global growth, driven almost entirely by the ultra-wealthy, not regular folks like us. Reason number 1, persistent inflation and rising living costs are forcing the middle class, the former engine of aspirational luxury, to cut back sharply. According to Bain, the personal luxury market has lost tens of millions of aspirational customers since 2022 because people feel betrayed by constant price hikes that aren't matched by real value. In the US and Europe, 60% of consumers are now turning to secondhand purchases to get luxury goods without paying full retail. If you're in your 40s or 50s with a solid income but worried about retirement or college costs for your kids, throwing money at these items is now closer to burning cash than investing. They don't hold value, they lose it fast. Let's start with the first asset, brand new luxury cars. I've seen founders on Shark Tank buy a brand new Mercedes to look successful, only to watch it lose 30–40%, sometimes up to 50% for certain luxury SUVs in just a couple of years. In 2026, with car loan rates still elevated and a flood of high-quality off-lease used vehicles, new luxury cars will depreciate brutally the second you drive them off the lot. Reports from Edmunds and CarEdge show models like Range Rovers or Infinitis can lose up to 74% of their value in 5 years. Drop $100,000 on one, and you're throwing away tens of thousands just to drive nice. That's not how the rich do it. We buy high-quality used cars or keep vehicles long-term to avoid depreciation. Second asset, luxury watches bought new from boutiques, Rolex, Patek Philippe, you name it. The high-end watch market has stabilized after the 2021 to 2022 hype, but retail prices have skyrocketed due to rising gold costs and tariffs. While the secondary market shows many popular models no longer appreciating like they used to. If you buy new thinking it's an investment, you're often paying a 20–50% premium over gray market or pre-owned prices. I got rich buying things that actually hold real value, not paying extra for a new box and papers. In 2026, with slow growth projected in China, the biggest market, demand for new watches won't explode, leaving you stuck with something that could lose value if you ever need to sell. Next, designer clothing and accessories, handbags, shoes, the whole thing. This is one of the weakest segments according to Bain. Leather goods and shoes are declining because price increases have driven aspirational buyers away. A new Louis Vuitton or Gucci bag is now easy to find secondhand for 50% less, and the quiet luxury trend is cooling the logo hype. Buy new in 2026, and you're paying peak prices for something that goes out of style quickly or wears out with daily use, delivering zero return. Fourth asset, lavish vacations and luxury travel. Sounds great, but in an uncertain economy, this is the first thing people cut. I've advised founders to prioritize meaningful family experiences over bragging about 5-star resorts. In 2026, with airfare and hotel costs still high, many middle-class families are opting for staycations or more affordable trips. That's money that could be invested and compounded instead of vanishing after a week. And finally, high-end tech gadgets. Latest iPhone Pro Max, expensive gaming laptops, you get it. These depreciate fastest of all, often 50% in the first year. In 2026, with new AI and tech releases coming constantly, what you buy today will be outdated tomorrow. Here's the part most people miss. We've seen this cycle before. Before the 2008 crisis, everyone poured money into luxury cars and big houses to feel rich. Result? Devastation. Before the dot-com bust, tech hype drove reckless spending. Now, after the post-COVID luxury boom, the market is normalizing, growth is slowing, and only the truly wealthy can keep spending without worry. If you follow the crowd and buy these things, in 2026, you'll fall behind because your money isn't working for you. It's disappearing. I'll throw in a couple of real headlines to drive it home. Bain reports the luxury market was essentially flat in 2025 and a modest growth in 2026, fueled by the ultra-rich, not the middle class. JP Morgan says China, the former growth engine, will be flat. Those are clear signs. Don't spend on overpriced assets when the economy is uncertain. So what should you do instead of keeping money flowing into these overpriced luxury assets in 2026? My approach, Kevin O'Leary's approach, is simple. Protect your capital first, then let it work for you. I'm not promising you'll get rich quick, because anything that gets rich quick usually loses quick too. Instead, think like the truly wealthy. We prepare for the downside and let the upside take care of itself. First, completely avoid the risky behaviors I just warned about. Don't buy new luxury cars. Don't pay inflated retail for Rolexes. Prices are already up 5 to 7% this year alone. Don't chase designer clothes that middle-class buyers are abandoning. Don't splurge on luxury travel when people are shifting to more affordable experiences and don't waste money on gadgets that depreciate like melting ice. According to Bain's latest 2025 report, the personal luxury market is projected to grow only 3 to 5% in 2026, almost entirely from the ultra-wealthy, while aspirational buyers like you and me are cutting back sharply because we feel the price hikes no longer match the value. Second, be cautious with anything hyped or driven by emotional spending. The luxury car market is flooded with high-quality used options at far better prices. The watch secondary market is more stable than new retail. And resale luxury is booming. 60% of US and European consumers are now buying pre-owned, according to JP Morgan surveys. Instead, focus on safe, sustainable ways to preserve and grow wealth. Here are the 3 moves I recommend, the same ones that help me build real, lasting wealth through multiple crises. Move number 1. Diversify into steady income-generating assets like dividend-focused ETFs or blue-chip stocks with high yields. I love funds like the Schwab U.S. Dividend Equity ETF, SCHD, or Vanguard High Dividend Yield ETF. They invest in large, stable companies that pay reliable, growing dividends quarter after quarter. They're not flashy, but they put cash in your pocket consistently and let you sleep at night, even when markets get wild. In 2026, as interest rates potentially ease further, dividends will look even more attractive. Move number 2. Add some gold or gold-backed ETFs to your portfolio. I've said it many times, gold saved me during crashes. With forecasts from major banks like JP Morgan and Bank of America pointing to gold possibly reaching $4,500 to $5,000 per ounce or higher in 2026, driven by geopolitical uncertainty and central bank demand. This is protect purchasing power. But don't buy expensive physical gold. Go with ETFs like GLD or IU for low cost and easy liquidity. Move number 3. Build an emergency buffer with high-quality bonds or treasury securities. They're the seatbelt of your portfolio. When everything else crashes, they hold value. Combine that with a little stable real estate if you already have experience, but avoid over-leveraging. The wealthy don't try to time the market perfectly. We prepare for the downside, recession, inflation, volatility, and let the upside take care of itself. If you adopt this mindset, cut wasteful spending, protect capital first, and invest in things that actually generate returns, you won't just avoid losing money. You'll build wealth steadily and stay ahead of the crowd chasing hype. I've watched too many people on Shark Tank go broke because of reckless spending and zero preparation. Don't be one of them. Ignore warnings like this, and you'll feel the pain later, when your wealth has eroded and you've fallen behind. But if you want to protect your money, think like the wealthy. And get more straight-talk advice like this, hit that subscribe button right now and turn on notifications. We'll get through 2026 the smart way, together. Thanks for sticking around to the end. I'm Kevin O'Leary, Mr. Wonderful, and I'll see you in the next